cool. This needs to stay here. This one. All right, guys, good afternoon. Welcome aboard to the Aftermarket Recap. My name is Carlos Garcia, founder and CEO of G.A.R Capital. Hope everyone's having a nice afternoon. It is 5:07 Eastern Standard Time, running a little bit late for our Aftermarket Recap, which is usually at 5. But thanks again for joining me today this afternoon. Bottom right-hand corner of your screen, a little black logo. Click on that, turn on notifications, subscribe to our channel. Make sure to hit that like button if you do like these videos. We'd love to do them for you. Let's go ahead and rock and roll. All right, that was Bloomberg. There's a couple of charts I want to show you guys in a bit, but we're going to go ahead and get started with just equities for now. Dow Jones down 0.69%, down 215 points. NASDAQ down 0.81. Off its session lows and definitely off its session highs. S&P 500 index 0.84% to the downside. Volatility index down up 4.42%. Equal weight S&P fared better than the S&P itself due to energy. Down about 0.43%. Small caps did better than the rest of the majors because of energy and financials. 0.28 to the downside, 172.60. 10-year yield did jump up 2.960%. Longer, the yield curve continues to be inverted. So let me go ahead and get that chart for you here on yields. Let's go to the yield curve. Real quick, I'll show you this one. And then we got some other stuff. We're going to go to a 1 month period. Okay, here you go. Here is yields, bond yields. Right now, we got the blue line being your 2-year, 3.17%. The 5-year being at 3.10%, and the 10-year being right below 3. Now, this is important, guys, because the financial companies or investment banks usually borrow against the 2-year note. That's kind of where they borrow, and they lend at the 10. The understanding that longer term bonds pay out more than shorter term notes. Well, now that the yield curve is inverted, it's the assumption that we're going to get higher rates in short term. The reason why the 10-year has been lower or kind of been subsiding, staying pat, is the fact that we're assuming now interest rate cuts or Fed fund rate cuts next year in 2023. Now, again, that's a long time from now. According to Morgan Stanley, it'll be February 2023 where we should get the first round of cuts. I made a note today on Investment Club regarding what are the 3 things that need to happen in the market. What are the things we're looking for? Again, a Fed pivot would be the most important. That right there is probably the king one, the big one. If the Federal Reserve says, okay, we're done hiking, the market's going to soar because now money availability is not an issue. If they say they decide to cut, meaning they pivot from being hawkish to dovish, and if they do cut, again, that's a pivot. That's going to be great for equities. Equities across the board, because now we're going to have more accommodative monetary policy, less restrictive policy. The dollar will go down in value. Again, better off for multinational companies to do business overseas. We talked about that today on Instagram. There was a post regarding IBM's earnings, 6% hit on their earnings because of currency headwinds. This is why the dollar matters. This is why we talk about it every day. So again, looking at the yield curve, again, the longer end curve, the 10, is a lot less in yield. You're talking about 22 basis points difference from a 2-year, and yet you're saving 8 years. So again, if you have a longer term approach, you can see that inflation fears or any kind of rate hikes in the longer term are going to subside. So again, the bond market is telling us a lot of things. Right now, it's saying that yes, inflationary pressures are still there, but not as high as it was at the end of the month last month. We got at least some decent numbers, not in terms of the inflation front, because that did spike. Remember that high CPI and PPI number? But again, we got that bad news out of the way. Let's see what August brings us. But again, the bond market, at least on a relative basis, you could see here, it's just kind of just holding in place, kind of stuck in a range between, let's call it 325 and around 290. Again, and that's pretty good in terms of bonds lately. They've been very volatile. So the market is kind of pricing at least some accommodative policy in February. That's being the big thing. The second thing is the earnings revisions. Again, we need to see if earnings revisions are going to be down. Again, that recalculates the PEs, which is the profit and earnings PE multiples, how we evaluate stocks. So again, what could be cheap today could be pricey tomorrow. or expensive tomorrow. So again, we always want to find value. If you guys remember, we did buy last week some Chevron when we got to $90 a barrel on oil. Where do we hit? $90 a barrel. 90 to 95 was our buy zone. It is now at 98, 86. Before we start taking a victory lap on this trade or anything, the fact is that we like oil to go higher as we expect the dollar to at least ease off 20-year highs. I think the dollar does come back down to earth, at least in the near term. Let's call it 3 to 6 months. And then oil should revamp higher. But all of this, guys, yes, demand is a little less. We do have some inventory build. But all this crude oil energy to the downside is really the dollar because that's what oil is priced in. So again, let's not get too excited about any kind of real change, at least in terms of refining capacity or finding or pumping more oil. It's just the good old-fashioned dollar being stronger, and your dollar can now buy more things than it used to. So that's your bonds, that's your dollar, that's your crude. Crude being up 4.5%. What was down today? The dollar. The dollar was down nearly 1% today at one point when it tested 107. Now it's down 0.59%. Going back to gasoline futures, 325 a gallon, up 1.31%. Again, the dollar being down helps, but refined gasoline has actually been going down in a faster pace than crude oil. Gold futures were up as well with the dollar being down 0.20%, 1707. So again, not a lot of risk off movement. A lot of this was just a technical move, and I'll go over that here in a second. Silver down up 0.22% as well. Bitcoin was up a lot higher today. Bitcoin hits, if I can get my spot price, we got as high as on the peak around 22,762. We are now at 21,612 currently. Again, still up for the day. And Ethereum soared today off its highs, the highs being right around 1530, let's call it. It's now trading at 1481. Remember when we posted that we bought Bitcoin on that bounce on the log chart on Instagram? Again, we are up nicely on it, but let's not get too excited either. Let's not make a victory lap. It's not like I'm going to sell Ethereum or Bitcoin today anyways. Let's go and answer this quick question real quick. Carlos is asking, do you think a good earnings report next week could lead the way out of this bear market? Yes. Again, that was that second part, which was the earnings revisions. If earnings are okay and there's no revisions to the downside, again, forecasting is the key word, guidance is the key word, or revisions. Those are your kind of key buzzwords you're going to hear on CNBC, Bloomberg. That's what we want to hear, the meat. Remember, all the earnings we're getting now, guys, are from last quarter. It's not forward thinking. So again, we want to see earnings revisions, forecasts, estimates, whatever you want to call them. That's important because now we can price ourselves on a forward multiple that's probably more correct than the current multiple. So when you have a PE multiple, that's current stock price plus earnings that were just announced in the previous quarter or the last earnings. If you go to forward PE, we're doing it by guidance. Big difference. So again, you have Shiller PE, you have regular PE, and you have PE multiples based on a forward level. The Shiller PE also includes inflation. So again, it's inflation adjusted. And Shiller PEs right now, again, still relatively pricey on a historical basis, but yet regular PEs right now are trading right around a 17, 18 multiple, maybe 17 and a half on a forward basis currently. If earnings are slashed, let's just say someone big has a bad quarter and their earnings are slashed, again, those multiples are going to change because let's say, for example, stock, whatever, ABC is trading at 100 at a 10 multiple, that gets slashed. Let's say the stock falls 20% down to 80. Those multiples, without any change in terms of earnings, got cheaper on a PE basis. But if those earnings also fall as well, we have to recalculate everything. And for all we know, if the earnings fell another 20% as well, then all things being equal, the PE is exactly the same it was from 100 to 80. But again, that's kind of just funny math. You can do kind of numbers around that. But again, that's what we talk about in terms of valuation. Again, do you want to pay 50 times earnings for a stock? Sure, but you better see some growth. A, are you willing to invest in a company that only has a 5 PE, 6 PE? Well, why is it so cheap? Because there's no growth. It pays a dividend. So again, everyone has something. Let's go ahead and take a look here. The one last part, the third part of the top three list that's important is 3,500 being that 200-day moving average that we haven't broken since COVID. So again, one of those three got to hit. Either we're going to get 3,500, we're going to get earnings revisions, or the Fed needs to pivot. That's really the main things we're looking at as of so far in terms of investing. In terms of trading, we're really just doing short term. Let's take a look at the S&P. I went ahead and posted this chart if you guys remember today. Let's see if we have the current price. We are trading at 38.30 currently. Is that the same price that we are for SPX? I just want to make sure. Yeah, 38.30. Perfect. Just want to make sure because this is a loaded chart. I just want to make sure that it was actually up to date. So again, right around 10 in the morning, we talked about it. Again, I didn't trade it in terms of the fade because tech was so strong. But again, right here, you could see 38.94, 3900 is being that next resistance on this channel to the upside. And we rejected it pretty close. Now, we did have the news come out that Apple is slowing down hiring. They didn't say anything about firing anybody. Again, just slowing down hiring. Same for Goldman. Again, if it was massive layoffs, then there's something to worry about. But in terms of slowing down hiring, I mean, that makes sense when we have a tight labor pool anyways. What we have is labor participation issues. They're very low. Again, a lot of people are opening their own businesses and doing side hustles. That's not going to count towards employment unless they actually file correctly. You may want to check with a tax professional on that. And then the second thing we're talking about in terms of jobs is that hiring people costs money. Training costs money too, guys. And if you're going to train somebody, unless you have a contract for them to work, they could quit at any time. It's an at-will state, Florida being an at-will state, for example. So again, Goldman or Apple is not going to pay the high labor costs that we know we have now due to high inflation and low labor pool, that we're not going to just hire someone on a frenzy like we used to when we needed the workers in 2021. So again, I'm not buying this negative connotation of slowing down hiring. Layoffs, yes, but slowing down hiring, I actually think that's pretty prudent and it's actually reducing expenses. To me, that doesn't show any issues with growth per se, because you can also have price adjusted growth or growth based by the store or whatever. Again, you can kind of use any numbers, metrics you want. But again, slowing down of earnings growth of hiring isn't exactly a deal breaker to me personally. Again, it just happened to fall right at this resistance level here around, let's call it 3,900, just for argument's sake, right around 38.95. So what does that mean? Well, we do have a gap to fill right around 38.01. Maybe we fill that overnight. That could possibly happen. If we reject and sustain to the downside, guys, remember that 3,500 we were talking about? We're pretty darn close to that if we retest that level to the downside. Now, again, we haven't gotten close to around 36.41, which is our year-to-date lows and 52-week lows or whatever lows you want to call them. But we have been holding on to this level here of right around 37.23 so far in the past, let's call it 3 weeks. So again, if you're a trader right now, you're really looking at this resistance here. If this does break, which is 3,900, your next point higher will be the gap fill, which is right around 40.15. If this stays to the downside, we're just going to fill this gap here of around 38.01 or so, and then we could definitely hold or head a little lower down and retest the lows of 37.32. The good news is that there's only one gap fill intermediate time frame of around 3,800 that could fill overnight tomorrow. The only other gap fill is right here, 37.09. So that's your downside possible move. It fits the narrative again of more downside. What also fits this here is earnings. Good news, at least we had some kind of a mixed bag in banks. Have been kind of underperform or has been underperforming the broader market. So again, banks are not a really good barometer. So once we start getting tech, again, tech is such a large part of the S&P. If tech doesn't at least perform, maybe Google doesn't perform or Amazon doesn't perform, Tesla reports this week, they're a part of the S&P, obviously. Again, a lot of scenarios can come into play where we start filling some gaps here at 3,800 and 37.10 right after earnings. Again, that's that earnings catalyst. This is why I haven't really gone in and started buying stocks in mass. Again, CVX, that's important because it's oil. We already got the correction we wanted in oil. So that positioning is fine. Could we get a little lower in oil? Sure. Recession fears coming higher? Fine. But again, with that, again, on a technical basis, there is a more of a lean to be short because you have two gap fills to the downside versus one gap fill to the upside, which is 200 points away from where we are currently, where our current price, we have 30 points and around 130 points for the second gap fill. So again, it can go either way, obviously, but again, S&P, I tweeted this earlier, again, that rejection level is holding so far, but again, we could always bounce tomorrow with some good earnings. True, but I expect this gap to be filled relatively soon. Let's take a look at Bitcoin. If you guys remember, we did that log chart. Let's take a look here. Again, all I did was a year-to-date chart on Bitcoin, a one-year chart, excuse me, rolling from last July to this July. And again, I just wanted to put a quick trend line here to the downside. It looks like we're hitting some kind of resistance, but we broke above it too. The only issue here, guys, is that we have a little bit of a base here. So again, we're kind of trying to see where are we heading? Are we heading up or down? As we know, if we bring up the actual Bitcoin log chart that I did earlier, I think it was a couple of weeks ago. We'll go to my grid here on the Bloomberg terminal, and we'll go to BTC log. Here's the log chart. This is back from July or so. Yeah. So if we go and bring up the log chart, if you remember, we do have this downward trend as well. So we do have a little more room to go, possibly 24 grand. And then we have a kind of a range up top here that we could possibly break. So again, Bitcoin does have some room to the upside around 24. But really, this price action here, guys, nothing has really changed, at least fundamentally in Bitcoin that I know of, and the chart is not reflecting it. So again, this is a 6-month chart versus the 1 year that we had, and this is a log chart, and you can see that we do have some room. But if we compare it to just the linear chart, you can see that we have kind of broken above resistance. So again, depending on what you see, I'm going to lean more to the log chart because we could just retest here that June 15th level and then reject. So I don't think we're closer to resistance as of yet as we have on the linear chart. Again, we did kind of break above that. But again, we know that resistance is not, just a roof over your head either. It can break. But again, we do have a little bit of room here on Bitcoin, possibly to, let's call it 2402 or 23,500. Let's say 23,500. So Bitcoin could have some more upside, sure. Let's take a look at Ethereum. We'll bring up the same year-to-date chart together. And there's anything really here that we can look at? I mean, possible trend line break, sure. Maybe we'll go ahead and throw in a line here. Let's take a look. We'll throw it in here at the top and see how we go. So if we go to one spot, two spot, you could see a nice little break here on Ethereum. So Ethereum does have a little more room to the upside. At least it looks like a better chart than Bitcoin. So again, take this information how you want to do it. I don't trade crypto personally, but again, if you are looking for more upside, 2,000 should be a target. If you're looking for kind of a stop, maybe I'd wait for a little longer, possibly go long Ethereum, maybe above 1550, and then you could put that 1480 as a stop. But again, I wouldn't advocate trading Ethereum because of the leverage. But again, you could have some more upside. But again, we could just kind of peep our head out and come back down as well. So it's really 50-50. But to be fair, Ethereum looks like a better chart. We'll go and leave it there, guys. Have a great rest of your afternoon, and I will catch you guys tomorrow for the morning note. Cheers.